You put money in the safest place you know, Treasury bonds, high-grade corporate debt, maybe a money market fund your advisor swore by. And for the first time in your life, it doesn't feel safe. Not because the math changed, because everything around the math changed. For decades, safe meant predictable. You lend to the government, they pay you back with interest. Simple, boring, reliable. But in 2026, that reliability comes with a price tag nobody mentioned. Treasury yields are hovering near levels we haven't seen since before the financial crisis. Sounds good, right? Higher returns on safe assets. Except when bond yields spike, it's usually because someone is worried. Maybe it's inflation that won't quit. Maybe it's debt piling up faster than tax revenue. Maybe it's the quiet fear that central banks can't keep performing miracles forever. So you're getting paid more to take on what used to be no risk at all. That's not safety. That's a premium for uncertainty. And it gets stranger. The assets people fled to during every crisis are now competing with everything else. Stocks are volatile. Real estate is sideways. Crypto is still crypto. So money floods into safe assets, pushing their prices up and their real returns down. You're being paid to wait, but inflation is eating the reward while you do. Let's talk about what safe actually means. Traditionally, two things. You get your money back, you get a little more than you put in. No drama, no sleepless nights. The U.S. government has never defaulted on its debt. That's the whole pitch. But safety isn't just about getting your dollars back. It's about what those dollars can buy when you get them. And that's where things crack. Inflation ran hot for years. Central banks raised rates to cool it down. It worked, sort of. Inflation came down from its peak, but it didn't go back to sleep. Even at 3%, your money loses 3% of purchasing power every year. If your Treasury bond pays 4%, you're only really earning 1% after inflation, maybe less after taxes. Suddenly, safe doesn't mean protected. It means slow erosion. Now the system under the hood. Governments are borrowing more than ever. The U.S. national debt crossed $36 trillion. Servicing that debt costs hundreds of billions annually, and as rates stay elevated, that cost grows. More borrowing means more interest payments. More interest payments mean more borrowing. All of it depends on investors believing the government will keep making those payments. They will, probably. But probably is doing a lot of work there. Bond markets are supposed to be boring, but lately they've been anything but calm. Yields swing wildly. Liquidity thins out during stress. The assets everyone assumes they can sell instantly become harder to move. In 2022, the UK pension system nearly collapsed because bond prices moved too fast. The Bank of England had to step in and buy bonds to stop the spiral. That's what happens when safe assets stop acting safe. Central banks everywhere are sitting on massive bond portfolios from years of stimulus. Now they're trying to unwind those holdings without crashing the market. It's like quietly leaving a party where you're holding up the roof. Meanwhile, banks loaded up on bonds when rates were low. When rates rose, the market value of those bonds tanked. Banks didn't lose money as long as they didn't sell. But if depositors pull cash and the bank needs liquidity, suddenly those safe assets become a problem. Silicon Valley Bank in 2023. Plenty of assets, just not liquid ones at the right time. So here's where we are. Safe assets pay more than they have in years, but the system holding them together is more fragile. The institutions managing them are more leveraged. The markets trading them are less liquid, and the backdrop, high debt, sticky inflation, geopolitical tension, makes everything feel one surprise away from breaking. The financial system is built on layers of trust. You trust the bank trusts the government trusts investors will keep buying debt. Everyone trusts central banks will step in during crisis. That trust has held, but trust is like a bridge. It works until it doesn't. Safe investments still exist, but safety is no longer the absence of risk. It's the management of it. You can still buy a treasury bond. You'll probably get your money back, but the feeling you're supposed to have when you do, the quiet confidence, the peace of mind, that's harder to find. And maybe that feeling was the real return all along.